Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. With all the talk of chips, artificial intelligence, all kinds of new products and technology coming out, the one company I keep coming back to is Taiwan Semiconductor. This is a company that fabricates most of the chips that companies like Apple and Nvidia produce. They're even producing a lot of chips for Intel these days. So the simple question I want to ask today is this a good buy? I think the answer is yes, but I want to get into why in this video. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing, in the link in the show notes for more on great companies like this. And I want to start with a couple of simple charts. And this just shows exactly how much revenue and net income has grown at Taiwan Semiconductor over the past decade. You can see that right now revenue is $75.1 billion and net income over $32 billion. Look at that net margin. A lot of the times if a company can generate over 50% gross margin, that's a great sign. Operating margins in excess of 20% are really good. Taiwan Semiconductor has a net margin that is approaching 50%. That is just a phenomenally profitable company. And that's really, I think, the foundation with which we should look at the stock. Now, if you go over to the second chart I want to show is related to net income, and that is return on assets. So when you put assets in, so when Taiwan Semiconductor builds one of these fabrication facilities, a fab, it costs tens of billions of dollars. But what is the return on those assets? That's really what you're measuring as a chip manufacturer. And Taiwan Semiconductor's economics are just phenomenal, in excess of 20% return on assets. And you can see that return on assets has been over 15% for the past decade. So this is a consistently profitable company. One of the reasons is they don't just scrap old facilities, they keep operating them. So they keep generating cash from older facilities. And those older nodes, they just keep expanding their production base. This is really the difference between Taiwan Semiconductor's manufacturing strategy and Intel's manufacturing strategy for a long time. They would just update their equipment in the same fab. So this has been a very successful strategy for Taiwan Semiconductor, leads to extremely high return on assets. So the economics are good, great growth, great margins, great return on assets. The next question is the stock a good value? And I think the answer to that is once again, yes. You can see here that the stock trades for under 16 times earnings. That's a very reasonable multiple, especially for a company that has this kind of moat. Taiwan Semiconductor is arguably the most advanced chip manufacturer in the world. Like I said, they're making the chips for Nvidia. So when Nvidia has a great quarter, at least some of that money is going to go to Taiwan Semiconductor because they're actually manufacturing the chips that Nvidia is making. Same thing for Apple. Same thing for AMD and Intel. All of the growth these companies have, all of the demand increases requires the manufacturing prowess that Taiwan Semiconductor puts in place. They have a lot of suppliers, and that those are valuable pieces of the value chain as well. But Taiwan Semiconductor is the one actually producing chips. They're the ones putting tens of billions of dollars into the ground building manufacturing plants. I think that's an incredibly valuable position to be in the value chain. They have the growth, they have the margins, they have a return on assets, and they're trading at a reasonable valuation for investors. So I think there's a lot to like. Whether you're interested in the growth from artificial intelligence or new technology use cases like autonomous driving, Taiwan Semiconductor is going to play a critical role in all of these companies. And I think despite being a very capital intensive business, which is kind of out of favor right now, this is a phenomenal company to just simply buy and hold long term. But what do you think? Let me know in the comment section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.